This is Rob Rowan with CFA Society New York. Welcome to our podcast, Compound Insights. I am very pleased to introduce you to two of my favorite ex-coworkers from my time at Fitch Ratings, Sonola, CFA, and Doug Offerman. We're here to discuss the issues that are facing state and local pension plans. Olu is the Group Credit Officer for the U.S. Public Finance Group at Fitch Ratings. Prior to joining Fitch, he was with PricewaterhouseCoopers and KPMG. He is also an adjunct assistant professor of public service at New York University. Olu earned his bachelor's degree in economics from Lagos State University, a master's in public administration from Columbia University, and a doctoral degree from Rutgers. Doug Offerman, our other guest today, is a senior director in Fitch's U.S. Public Finance Department, and he is Fitch's team leader on public pensions and OPEB issues, which we'll be talking about today. Doug was previously a financial consultant for several large healthcare-related nonprofit organizations and a research analyst for Citizens Budget Commission of New York. Prior to that, he was at the U.S. Information Agency and the U.S. Trade Representative's Office and the state of California. Doug earned his bachelor's degree in history from UCLA and has an MBA from Columbia Business School. So, Doug and Olu, it is nice to talk with you guys again.
Nice to be here. Thank you for having me. And thank you for having us.
Well, so I would like to talk about one of the issues that has been creeping up here. And when we first started planning this podcast, we were talking about how it had not received a lot of attention, and that is the investment performance of the public pensions. Due to the smoothing of investment returns, some of them were still feeling some of the impact of the Great Recession for years after that. And now we have the COVID-19 volatility. As well as some weak years in the years preceding the Great Recession. So what are you all seeing in terms of performance?
So, Doug, I'll let you start, then I'll comment.
Sure. Definitely. So, it's been a pretty rough year. That's not news. The last 2 months have been pretty devastating for investment portfolios kind of across the board. The most pension systems have a fiscal year end and an actuarial valuation date that's on June 30th. So like a lot of certainly pension managers, pension watchers are waiting to see how things look on June 30th. There are some plans that have valuation dates outside of that year end, but in large, June 30th is going to be the most important number. The bottom line is April obviously saw a big upswing in value, but relative to investment return assumptions, portfolios are likely to be substantially down. So it's likely to be a hit that is on par with, if not worse than, the Great Recession more than 10 years ago.
Yeah, that's one of the things that I think gets left out of these conversations sometimes. Very often we see it in the press, they talk about it in absolute return terms. But of course, pensions have to manage to the bogey, and they are missing it pretty consistently. Olu, do you have any thoughts on this from your perspective about the performance?
Yeah, I think we actually published a study on investment return performance about a year ago, and we honed in on that particular point. If you look at states across the board, and this study was we studied the years between 2001 and 2017, pretty much all the states in the United States, with the exception of South Dakota, pretty much all those states underperformed their expected rate of return assumption. And it's fairly remarkable. I remember for about 6 of them, the differential was about 2% on average every single year over that time frame. So we've seen this as a consistent issue where plans have underperformed relatively high expected rate of returns. And given the environment we're in now, this is most likely going to be another year where they underperform.
Right. And this has been on a couple of backgrounds here. So as you say, the decade after 2000 was subpar performance. not just because of the Great Recession, but also in the years preceding that. Some of the years since then were pretty good. But there was another thing that started happening a couple of years ago when some plans started to lower their investment return goals, thereby raising their obligations as well as the performance. So, could you talk a little bit about where the overall obligations have gone in those years, also?
Well,
Go ahead.
the obligation for retirees has grown. I mean, that is that's partly because over time, workers have accrued more benefits, but it's also because retirees are living longer. Then when you layer onto that the dynamic that you mentioned, Rob, where the investment return assumption has dropped, essentially, that discount rate falling pushes up the liability further. So it's hard, given the legal structure of state and local pensions, where benefits by and large are protected. It's hard to revisit the level of benefits that's already been promised. So that handcuffs, in a way, pension managers and state and local governments if they want to pull back on the benefit side to only changing the benefits of new workers. So it's definitely, a dynamic that's, potentially troubling. Let's put it that way for the outlook for pensions going forward, particularly once you layer on the investment losses that are likely to be booked this year.
Mm-hmm. Mm-hmm. Well, let's talk about that for 1 second, because obviously not all the pensions are in the same position by any means. Some of them are much better shape than others. So, do you think that this year will have an impact even on those that were going into this year in pretty good shape? How do you think those will come out of this?
Well, there's, this is Rob. This is one of those topics where there are some unusual ironies for pensions. So, if you think about a plan that's 100% funded by its own standard and it suffers a 25% market loss, it's lost a tremendous amount of funding, 25%. Ironically, if you look at a plan that's 40% funded, it only drops to 30%. It suffers a 10-point drop. So in some respects, the hit to better funded plans, the magnitude of that hit is far larger. For the more poorly funded plans, their contributions theoretically, hopefully, are already reflecting the gigantic funding gap they have to reach full funding. But for the larger funded plans, they may see a relatively larger increase in contributions from government. So it's one of those sort of important side note stories to this broader dynamic of market losses, is that some better funded plans may see worse hits.
Mm-hmm. Mm-hmm.
Yeah, it gets to that saying that if you're broke, you're not worried about the stock market. You're not worried about where it ends up. So I totally agree with Doug on that.
Well, let's talk about a couple of the demographic things that are happening right now too. Doug, you touched on that people are simply living longer, and that is having an impact. Has your research into demographics yielded any other clues about what might be next? I don't think we have any expectation that the trend, demographic trends, are going to change. It's a context factor for pensions in our time. As retirees live longer, the obligation of their former employers has to rise. It's just that's just a fact. The
some research that we've done recently, and I'll turn to Olu next, but some research that we've done recently kind of focused on this dynamic of funding on the one hand versus the economic dynamics and the labor force dynamics of a state. Larger labor force states versus faster growing labor force states versus slower growing. And one of it affirms some of what we expected to see. So, for example, the states with older populations and more retirees were also more likely to have large liabilities. But part of the takeaway was that the actions of management could have a material impact. So you could have a Rust Belt state with a very, very strong, a very well-funded plan. You could also have a Sun Belt state with some potential problems in the future. But arguably, the Sun Belt state is better positioned over time to address the problems in their pensions simply because they have growth in their favor. They have more young people and they're attracting population.
Okay, that is really interesting. Olu, did you see anything else in that survey that you were working on?
No, I think, when most advanced countries are entering this phase where they're having to deal with an aging population, and the U.S. it's one of them. You're seeing much lower birth rates. You're seeing higher life expectancies. And you're also seeing, the baby boom generation essentially cross that 65, that age 65 marker. So it's not surprising that combination of these factors that leading to a U.S. Workforce that's projected to decline over time as the country ages, and you're also seeing notable variations across the states. So states like Maine, states like Vermont, West Virginia are aging a lot faster than many other states. States like Utah have a very, very young population. And the consequence of a declining working age population is that ultimately, it affects economic growth. And we all know that economic growth at the state level, actually anywhere, underpins tax revenue growth. So to the extent that economic growth slows, you're going to see you're going to see tax inflows also slow. And that's the money that states use to pay pension benefits, retirement benefits. That's also the money that states will use to pay other expenses associated with an aging population. So there are lots of, the variety actually is pretty much all over the place, and you really have to pay attention to. And the analysis is on a case-by-case basis or a state-by-state basis, I should say.
Mm-hmm. Mm-hmm. Well, let's perhaps take a turn into policy here. My understanding of this, there are several factors. One is a relatively uncertain policy from the federal government. Another issue around policy is the stoppage of decision-making processes around this issue in states that have divided legislatures, which brings everyone to a point of wondering what is next. So what do you all think this is going to yield in terms of the states that are currently have pension plans that are less well-funded and have some type of stoppage in their legislature decisions?
Rob, that's a very good question. It may partly depend on, and this is just speculation, but it may partly depend on what things look like when the dust settles. Funding policies from one plan to another are very, very complex. So it's relatively rare to have a funding policy where the contribution just floats upward. In many cases, there may be caps, for instance, on percentage of payroll. There may be other factors, and so that may mean that a state sees a liability problem when the actuaries get around to valuing the plan, whereas the plan's contribution determination is done in an approach that doesn't fully capture what's going on. So similar to Olu's point about economic growth, the reaction within individual states is going to be threading the needle of existing funding policies and existing state laws, as well as this broader protection of pension benefits that, you know, it makes the prognosis for some like magic bullet change very, very dim. We didn't expect it before, but I wouldn't expect it to change now. Pensions, by and large, are protected under contract provisions of state law. And it's our working assumption is that once granted, they're not taken away. So whether there's a consensus for deeper reform, I'm guessing that is entirely possible. But again, that's going to be on a state-by-state dynamic.
I think we saw some of the tension that last week and the week before this when some of the stimulus discussions were going on, and the topic of states going bankrupt was the response.
Right.
For the record, as you are two professionals of this, can states go bankrupt?
States cannot go bankrupt. It certainly flags for discussion a topic that state policy makers need to think about, not the bankruptcy, but the pensions. It also really points to the fact that we're in a downturn where the problem that states are having is an economic and a revenue downturn. That will ultimately feed into budgetary and spending choices that states make. But the crisis for states is economic and revenue rather than pensions per se in this moment. The pensions will be part of the policy discussion going forward.
Yeah, and you know, as Doug said, under current law, states can't file Chapter 9. However, you alluded to the comments of the Senate Majority Leader, Senator Mitch McConnell, and it seems to me that it's basically just political posturing because you have to change current law. And you and I know that Democrats control the House, Republicans control the Senate. And Democrats have no interest in letting states go bankrupt or, signing off on a law that would allow states to go bankrupt. So for me, it's more, I would interpret that statement, and it seems that he actually backed off that statement 2 days ago. But I will interpret that statement as trying to manage expectations in terms of how much money ultimately flows from the federal government to the states. And as we all know, anytime Congress appropriates money to states and local governments in particular, most times there are strings attached, and they always have ways of policing their money. So I'm sure that will also happen now. But it seems to me that ultimately, as Doug said, it's a crisis situation where you're seeing tax revenues plummet because of the shelter-in-place policies that we've seen, and you've seen economic activity grind to a halt. So we'll have to see, but I would clearly say that it's unlikely that we'll see any change in law anytime soon on that point.
Okay. Well, I would like at this point to circle it a little closer to home for you all, because I think that there is sometimes some people miss exactly how pension pressures are calculated into state and local ratings. Could you explain a little bit about how this picture is bleak and how it works into your ratings?
Sure. So in our criteria, what we do is we focus on the contributions and we focus on the liabilities. For the contributions, we essentially think of, well, in general, we think of pensions and debt as being equivalent obligations, long-term obligations that have a claim on the cash generated by a state or local government. We add together the actuarial contributions for pensions along with OPEB-PAYGO contributions and debt service, and we measure what we call carrying costs. So we measure that against expenditures. On the liability side, and this is important, given our concerns about the high discount rates, the high investment return assumptions that pensions use when calculating their liabilities, we readjust liabilities to a 6% rate of return assumption. That also happens to make the resulting numbers a little bit more comparable for purposes of assessing credit quality. But we think it's a little bit more of a realistic target number over time for portfolio earnings.
Right, so sorry, Doug, let me just amplify that for 1 second. So you make the expected investment return 6% for all state pensions. Right.
Correct. There are some technicalities that I won't go into for purposes of this discussion, but our target, the rate that we use across the board is 6%, and the result is that for most states the liability climbs well over what it is reported at for most state and local governments. And then we add that number, that adjusted liability number, to the debt number that states have outstanding, and we measure that against states' personal income or the local government's personal income, because that's the getting back to a point that Olu was making. That is getting at the burden on the tax base itself, and that tax base is ultimately what supports both government operations as well as covering these liabilities.
In terms of the immediate impact on the balance sheet of state and local governments, and also in terms of the immediate impact on higher contributions, in general, it's not necessarily an immediate impact. It takes a while for the losses to bleed in due to smoothing, and it also takes a while for contributions to increase. So that, to some extent, gives states and local governments some time to prepare. It doesn't mean they will be prepared when they now have to start writing the check, but at least you know what to expect. I think that's positive, and that's probably the only silver lining that I see in this current environment.
Doug, would you say? Yeah, Deb, would you say that smoothing is the silver lining?
Well, these timing lags provide a little bit of visibility, but like Olu said, they still have to prepare for the impact. They just know, for a liability, it's gonna show up on their books, but usually a year after the plan itself performs evaluation. For contributions, it's layered on as the smoothing proceeds, and so that could be spaced out over time. But the bottom line is, government managers should, certainly based on the experience of the Great Recession, see what's coming down the road. And the other thing is, and this is another, I think, interesting side story with pensions, is that actuaries have been working to ramp up their risk reporting. So every actuarial valuation includes a much more robust discussion of risk. And so this is a good time to become familiar with what actuaries are saying about the pension funds that they're valuing. And it would give pause to many public managers even before you get to the market losses that we've experienced in the last 2 months.
Great. All right. So I think we will leave it there. I will link to in the show notes to the report that Olu just mentioned from last year. When you all have it, that demographic one, I will also link to in the show notes. And I would like to just second the idea that watch those actuaries. They are going to be very helpful in this next phase. So I hope you all have enjoyed this episode of Compound Insights. You can subscribe to this podcast on the app of your choice and hear about podcast details on our website at cfany.org. Until next time, I'm Rob Rowan.